So today we are going to do mostly a review of the basics and the mechanics of accounting. And the biggest difference between this class and sort of the introductory financial accounting class is that now when I give you a transaction, you won't always know what to do with it. Okay? In sort of the first level accounting class, you pretty much are given super straightforward transactions, and given you kind of understand the basic mechanics of debits and credits, you know what to do with it. Here we're gonna, obviously nail down the mechanics by the end of today, and then we're gonna sort of come up with situations where you're not really always sure what to do, and we're going to discuss the theory and the kind of basic principles behind deciding how to treat different transactions and what to do when things aren't quite as neat as they are in the textbook. Okay, so we've got an accounting system in place, and the accounting system has this sort of lots of different functions, but from the external perspective, the accounting system needs to take all the transactions that occur, collect them, process them, aggregate them, and turn them into a set of useful information for external users. Okay? And what would we think would be useful information? Well, remember, it's information that's going to help us determine the amount, timing, and uncertainty of future cash flows. And it's information about the resources of the firm, so the assets, about the obligations of the firm, the liability, the claims to those resources, potentially owner's equity, changes in those resources, differences from year to year on the balance sheet. And we want to know, maybe even more specific questions like how much debt is outstanding and what kind of debt is it? So is it debt that is senior to the kind of debt that I would be potential? So when I'm thinking about lending to a company, if I lend to this company and they go bankrupt, who's going to get paid first? Now, of course, there's a bankruptcy court and things might be different than the explicit rules, but at least I want to know what can I expect? Or how's this company doing relative to last year in terms of generating sales? What kind of assets is the firm requiring in order to generate those sales? Do they have to invest more and more each period just to kind of eke out the same amount of sales, or can they reduce their investments in assets? Are there some economies of scale, so the more they sell, the fewer assets they actually need to sustain them? What's happening with the cash? Do they have enough cash? Are they running out of cash? Are they using it wisely? Are they profitable? So not only are they making sales, but are they keeping money after the sales and all the expenses are considered? Okay, so lots of companies, when they start up, they do have sales, but their costs are so high that ultimately their earnings end up being negative. Are there any separate or particular segments of the company that are doing particularly well or poorly? And if so, what is the company doing about it? Is it something that they could spin off and get rid of, or is it something that's essential to the firm and it's a sort of loss leader, we have to suck it up, and then at least we have all these other benefits in other segments? Can the firm and should the firm increase its dividends? If it doesn't increase its dividends, what's it doing with the cash? Is it using it wisely? Okay? And am I generating positive or increasing returns on the reinvested assets? So if they keep money in the firm and then they invest it back in there, are they actually making money for me? Okay? If they're not, I'd rather they just give me my money back and then I can go and invest it somewhere else where I think the returns would be higher. Okay? So those are the kind of questions we want to ask, and we need an accounting system that is equipped to provide us the information that will help us answer that. So the first thing we start out with is our balance sheet. Okay, our balance sheet is the thing that's going to tell us the assets, the liabilities, and other claims or the residual claims on those resources. Okay, and we call it the balance sheet. Why do we call it a balance sheet? Because it balances, right? So what do you mean it balances? What is that? It means assets have to be equal to liabilities plus owner's equity. So if you were, kind of like in the old days, looking at a company's, they would record their assets here, and you'll still see this sometimes in a textbook, but never in real financial reports. And on the left-hand side, you would have a list of the assets and all the amounts here going down like this. And then here you'd have a list of the liabilities and the amounts and a list of the equity and the amounts. And then the balance sheet would balance because you'd have an amount here, you'd have an amount here, and they would be equal. Okay? But we don't really write things like that anymore. Now we always just have sort of one column. We have all the assets, and then underneath we have all the liabilities and equity. Still, people, when they refer to the right-hand side, they still mean that stuff. So if somebody would say, oh, we're going to shore up the right-hand side of our balance sheet, it means they're talking about trying to figure out how to reduce their obligations or figure out how to restructure their payments so that they're not kind of having difficulty making them. Okay, if they say, well, we're going to focus on the left-hand side of our balance sheet, that means they're thinking of making significant investments. Okay, so we still use the terms left-hand side and right-hand side, even though technically we have just like one column of all the information. Assets still equal liabilities plus equity, and we always need that equation to hold, not just at the end of the year when we make the balance sheet, but at every single point in time. Okay, so how is it possible that assets are always going to equal liabilities plus equity? So let's say I go out and I buy a new machine. Well, obviously, I now have another asset. So how is my equation going to hold if I now have a machine? I didn't have it before, so obviously my assets went up. How is this equation going to hold? I spent some money, right? It's not like I just had one thing happen. I went out and I bought a machine. So I paid cash, so my one asset went down, and in exchange, another asset went up. Okay, so that's one way the equation could hold. Another way would be I go and get a machine, and instead of paying for it immediately, I agree to pay for it in 3 months. What would be happening in that transaction? One asset would be going up still, right? I now have a machine, but what else is going up? My liabilities. Okay, so one thing goes up, one thing goes up. It can go the other way, like one thing go down, the other, either, as long as for every up, there's a, either an up on the other side or a down on the same side. Okay, so what does that really mean? It means if there's an increase in the asset, then there has to be either a decrease in another asset, an increase in a liability, or an increase in owner's equity. Okay, so for every transaction, we want a double entry. Okay, we want to know not only one thing that happened, but how did that happen? Okay, so double entry bookkeeping is not just like mechanical and annoying, although some people sometimes think it is. It's actually providing us the information of cause and effect. It's like, here's what happened and here's why it happened. Okay, so we learn a lot more from having the two entries than we would for just having one. Okay? Now, what do we learn? And we would interpret some of these activities very differently. So if the company has a new machine, okay, we want to know, how did it get that machine? Did it get that machine because it generated revenue? Okay, so it went out and it sold services to some other company, and that other company said, well, we don't have a lot of cash, but we'll pay you in machines because we make machines, sort of like a barter transaction. Well, that would be kind of a good thing, right? Because we've generated revenue and we got basically a machine in exchange. On the other hand, if we had to go out and we paid in cash for it, that would look different to us. It would just be swapping out one asset for another asset. So we want to know why. How did we get this new asset? Did it come because we earned money? Did it come because we took out an obligation? Or did it come because we utilized other resources that we now no longer have to pay our employees or to do whatever else we could have done with the cash? Okay, or in reverse, let's say we sold. We don't have as much equipment as we did last year. Well, is that a good thing or a bad thing? I can't answer that unless I know what happened with the sale. Okay, it's not just good or bad to have more equipment. Did I need the equipment? Do I want the equipment? What did I get for the equipment? How much money did I make in that thing? So we want to know, I sold equipment and I got cash, or I provided services in exchange for cash, or how are these things happening, and how should I interpret them? So for every transaction, so double entry bookkeeping also means for every transaction we have, not only does the accounting equation have to hold, but we're going to have a debit and a credit. Now, I hope after taking a semester's worth of financial, you already got rid of any false connotations of debits and credits that might have been in your head. But in case you haven't, debits aren't good or bad. Debits aren't positive or negative. Debits aren't increases or decreases. They're all of those things. Okay, it's not one or the other. You cannot interpret a debit as being always a good thing. Okay, because for every single debit, there's a credit. So if it's a good thing, there's both a debit and a credit. Okay, so it doesn't mean good or bad. It doesn't mean more plus or minus in any particular way. Debit means left. Credit means right. Period. Okay. So when we say you're increasing an asset, okay, that will mean you're debiting the asset. Okay. But if we're saying you're increasing sales revenue, also a good thing, you're crediting sales revenue. So it just sort of depends on where the account lives, whether a debit is considered a positive or a negative, and whether it's good or bad, or whether it's an increase or a decrease. Okay? So let's just sort of take a typical account. Now, sometimes people who take financial accounting think that we're teaching them this textbook stuff that they're never going to use, and they're like, really? T accounts? Who makes those anymore? Well, let me just tell you, a T account is just a spreadsheet, okay, or T accounts in general. They're just two columns of a spreadsheet. Basically, spreadsheets were created to assist with financial transactions rather than the other way around. It's like, yeah, now we have a million other good uses for spreadsheets, but actually the original spreadsheets were created in order to facilitate accounting systems. Okay, so the way you want to think about it is, this is just one, this is one column and this is another column. Okay, so this is like, let's say A, and this is column B. You just merge A1 and B1 and you put the account name on top of it, you put some borders on it, and all of a sudden, voila, you've got a T account. Okay, it may not look like the little ones that you draw in your by hand, but it's the same thing. Okay, you can have, in any account, you can have debits and you can have credits. But look at this particular account. If you had to guess, take your best guess, what kind of account would you think this is? An asset, a liability, or owner's equity? Yes. Why? Okay. Okay, but I mean, even if this weren't an asset, I would still have to add up, I would still have a debit balance, right? Because if I have more on this side than on this side, it's just the way it is. But you're right, I mean, it's likely to be an asset because it has a debit balance, okay? What does it mean to have a debit balance? Well, it means that your left side is increasing more than your right side. So when you think about an asset, I could buy land and I could sell land, but can I sell land that I don't have? Can I have negative land? No. So I can have debit, I can have a balance that's a debit, I can have a balance that's zero, but I can't really have a credit balance in my land. Let's say I'm renting land. Is it my land? No, it isn't. So I wouldn't have an asset at all. Okay, so if I have an asset, it's going to have a debit balance. I can decrease that asset and credit it, but overall the balance is going to be a debit. Now, is it for sure an asset? Could it be anything else? Do you guys remember any of those kooky accounts that could not be like that? Yep. Okay, so it can't be a contra asset, because a contra asset would have, but you're right in the contra thinking, a contra what? Could be a contra liability or a contra equity account, right? Because then they would live on this side, okay? What else could it be? Could be an expense account, which is not, I mean, an expense account is effectively a contra equity account, but it's part of owner's equity, and eventually it will get folded into retained earnings. And finally, it could be retained earnings, because if companies generate losses over their entire life, you could have negative retained earnings. Okay, it's not nearly as common, and I definitely like the fact that you're thinking it's an asset, because that's kind of what I was hoping you'd think. But you've got to remember there are some quirky other possibilities. Another advantage of debits and credits, if you think this, if you're not good with negative numbers, so even though last time we listed why you're here, and I think one of the things was I'm good with numbers. If you're not that good with numbers, even you can do accounting, because you don't really need to sort of record this as a negative. You just sort of sum one side, subtract the sum of the other side. And it's hard to see how those two things are very different, though. Okay, so assets have debit balances because when you think about where they're located in the accounting equation, so assets equal liability plus stockholders' equity. Okay, assets, this is the left-hand side. So increases to the left-hand side are debits, right? Debit means left. So more stuff on the left. Okay. If your account is on the right-hand side, then increases to that account are credits. Okay, so an asset has a debit balance, meaning there are more debits than credits, and when you have an increase to the asset, you further debit it. When you decrease the asset, you further credit, or you credit it. Okay? Flip side for liabilities and shareholders' equity, they have credit balances, so if they're going up, you put another credit in there. Okay? If they're going down, you debit the account. That's just, so you don't want to think, oh, well, I have some notion that a credit is good because the bank gave me a credit and now I have more money. Well, yeah, but from the bank's perspective, it's not good. They gave you a credit and now they have less money, right? So you can't, there's no good in that. It's just left and right, okay? Okay, so what else do I want you to remember about the balance sheet and T accounts? Well, we've got our accounting equation, and we also have, so this is assets equal liabilities plus shareholders' equity. Sometimes you'll see it called stockholders' equity. Sometimes you'll just see it owner's equity. Owner's equity. They're all synonymous. Don't worry about it too much. Whatever you choose to use is fine with me. But owner's equity is split into two types of accounts. Okay, there's more separation than this, but this is just trying to give you a sense of what kind of things can happen. One thing that can happen in the equity section is that owners, specifically stockholders, give the firm money in exchange for what? So when you buy a share of stock, what do you get? Yeah. Okay, a share. What is a share of what? It means, well, you probably get. You used to get a piece of paper which said what you have. I don't even think you don't get paper anymore. Now you just have some, ones and zeros out in the ether. Okay. But what do you have in exchange for that money that you're giving them? Well, you have the right to a little fraction of the company. So after all of the debts are paid, if you were going to settle up and figure out, well, how much do I get? You get a little piece relative to your contribution. So if there are 100 shares outstanding, after all the obligations are paid, you own 100th of what's left. Will you ever see that money? Maybe, maybe not. What are the ways in which you could see that money? Okay, dividends. So the company could actually pay you cash each period to say thank you for giving us the money up front. Okay, what else? The stock could split. What does that do for you? Gives you more shares, but everybody gets more shares. It's not just they split it for me, they split it for, unfortunately, everybody. So if there were 100 shares, now there are 200 shares. Yeah, I own 2, but I still only own 100th of the firm. So splitting is the right idea, but it's not the split that matters. What am I hoping is happening to the price of the stock? It's going to go up. So even if I don't get cash dividends, hopefully the stock price is going up, and so if I want to get my money back, I bought it for $10 a share, maybe a couple of years from now I can sell it for $20 a share. So even if I didn't get cash along the way, I have an appreciation or a gain from having invested in this firm. That's why I do it. Otherwise, I'm not really interested. No, I'm not going to lose money. Are they promising me that I'll make money? What happens if they don't? Too bad for me, right? I can lose. How much can I lose? Just as much as I put in, and that's it. That's the good news, right? They can't come after me and take my car. They can only take as much as I've put in. That's the only reason. That's part of the reason you're willing to invest in corporations, because there's just limited liability. Okay, so this is what you contribute. The other thing that the company does is it now is functioning as a firm, and it's trying to make money on its own. It's taking the money you gave them, investing, and generating new money. Okay? And where's that new money going? Well, you're making sales, and you're spending money to make those sales. Overall, you're generating income. Hopefully, it's positive. Okay? And if it is, then you're going to increase your retained earnings. And retained earnings is also called, some people will call it, earned capital. So this is what we call contributed capital, which is just what owners gave you to work with. And retained earnings is what you did with the money that you were given, and you generated profits above and beyond what you started out with. Okay, so the retained earnings is saying, from the beginning of time until now, here's how much money the company was able to generate from all of the assets that it had after taking into consideration all the money that it paid back to its owners. So after considering all the dividends that we might have paid out, here's how much we kept within the firm and kept for reinvestment purposes. Do all companies pay dividends? Are dividends good? It could. Are there good companies that don't pay dividends? Yeah. Right. So paying dividends is not an automatic sign that you're good or not good. Paying dividends means the company decided that the best use of cash is to return some of it to the owner. Companies that don't pay dividends say, well, we have really good investment projects that we want to take that cash and use it for. We can't afford to give you the cash back because then we'd have to go to the bank and borrow money. So we're actually still kind of using the cash, even though we have been profitable and generated enough that we could pay you dividends. We don't want to. Okay, and there are a lot of technology companies that just don't pay dividends because they want to be cash rich so that whenever a really good opportunity comes along, they don't have to worry about seeking external financing. Okay, Apple is sitting on more cash than the U.S. government. Okay, you could argue they should give some of it back, but they think they're doing better with it than you, individual investors, might be doing with it. So they have more projects that are worthy of potential investment than giving the cash back. Okay, so when a company decides to give out dividends or not give out dividends, if the company doesn't give out dividends but does very well, what should happen to the stock price? It should go up. Do I want the stock price to go up as an investor? Well, it doesn't hurt, right? How do I benefit from the stock price going up? I actually have to go and sell my shares. So the good thing about dividends is I get them right away. The good thing about stock price appreciation is that it used to be, it's not so much anymore, but it used to be taxed more favorably, but the disadvantage is if I want to actually get that cash, I have to sell out and I have to get rid of my investment. So there is sort of a drawback to not getting cash back. On the other hand, dividends are, kind of a sign that the company doesn't have anything better to do with your money. So maybe you want to invest in firms that have really good projects. Okay, so now within the retained earnings account, so people mentioned this before, the idea that an expense could kind of have one of these quirky debit balances, even though it lives on the right-hand side of the accounting equation, and you're 100% right, which is retained earnings. You can sort of think about that as being composed of revenues and expenses. So retained earnings is basically net income minus any dividends that you're paying out. So this revenues and expenses are your income account. Now, when you finally get down to the point where you're preparing your financial statements and you are recording your balance sheet, you don't ever have revenues and expenses on there. They go on the income statement, and then they get closed out and stuck, kind of folded into retained earnings. So when we get to the final creation of the balance sheet, you won't see revenues and expenses. You'll only see retained earnings. So this is where they're going. As an expense, so as you have more and more expenses, what's happening to income? The higher your expenses are, the lower your income, okay? So, and what happens, the lower your income, is that a debit or, so if you reduce your income, is that a debit or a credit to retained earnings? To reduce your income, it's a debit, right? So you can see, expenses going up means retained earnings is going down. Revenues going up means retained earnings are going up. Okay, so it's sort of just, you probably know the right answer, you just got to think it through a little bit. Expenses are like a contra equity account, revenues follow the equity convention. Increases are credit, decreases are debit. Okay. So we're going to go through a bunch of, I'll give you a couple of examples of just some double entry, and then we're going to go through a long problem. Now I forgot to mention this. Usually, I will be posting slides that last for more than just one lecture. So when you look at the syllabus, it'll say, if the same thing is repeated twice, it means the same set of slides are used. So don't feel nervous that we're only on slide 4 and I've already wasted half an hour. We're only going to get halfway through this, and I'm not going to make you sit here for the next 25 minutes after class finishing. Just bring the same set of slides to the next class, because that's what we're going to finish them up. Okay, so owners invest $40,000 in exchange for common stock. So basically, we have a new company, they're starting out, and I go and I ask a couple people that I know, hey, will you invest in my firm? And I find a bunch of people who are willing to do so and give me $40,000. Tell me what's happening. Say it differently for me. Say it in accounting language. I'm telling you in words, owners invest $40,000 in exchange for common stock. Put some accounting structure on that. Okay, so debiting cash. What does that mean is happening to cash? Am I getting more or less cash? Okay, so we all agree that the company, okay, so the company is taking in $40,000 cash, which means their assets are going up by $40,000, which means cash, which is an asset, should get debited by $40,000. Okay, am I done? Why not? What else do I need to do? I need to tell you where that cash came from. Did I embezzle it? Did I steal it? Did I find it on the floor? Or do I owe a bunch of people pieces of my company now? There are a bunch of people who expect to get something in return. Now, will they? Maybe not. But at least I now have a bunch of people who actively can make my life miserable if I don't do something good with their money. Okay? So what is the other thing that I was... What else is going on? I'm increasing the amount of ownership, okay, or the amount of common stock that is outstanding. Okay, so here's my equity goes up by 40, so I have assets going up by 40, owner's equity going up by 40. What do I do when an equity account goes up? Credit it, right? When an asset goes up, I debit it, so I do that. But when an owner's equity account goes up, it belongs on this side, the right-hand side, so when it goes up, what do? Credit, okay? So does this look okay to everybody? Now, after I do my journal entry, I do something called posting. Where do I post it? Well, I'm just basically taking this information and sticking it in a slightly different format. Why? Well, this would be like a huge list of just stuff, okay? And it doesn't really help me to have a 50,000-page list of transactions. I need to take all the transactions that have cash involved and somehow put them together. Well, how can I do that? Well, I can make an account just for cash, and any time cash enters, either as a debit or a credit, I'm going to stick it in this P account. Okay? Common stock, same thing. Now, how could my common stock account go down? And so far, my common stock account went up. How could the common stock conceivably go down? If investors sell it. Well, investors could sell, but who are they going to sell to? Other investors. So if the company buys back its own shares, so it says, look, thanks for giving us money, but we really don't like having you on our board, and you're kind of interfering with our activities, so we now have earned a lot of money, we'd like to buy you out, okay, and we'll buy back your shares. Okay, that's one way we can get rid of the common stock. Can you get rid of all of the common stock? Well, every now and again you'll hear about management buying out the firm, right? So there'll be like some situations in which managers kick in their own money and just try and privatize the firm, okay? But for the most part, what's going to have to be true about this? Well, we're always going to have either a credit balance or zero. We can't have a negative balance. It doesn't matter what the stock price is, okay? That has nothing to do with what the value of this account looks like. Either owners gave us money, or we used money to buy their shares out, and there are no shares outstanding anymore. But besides that, there's no such thing as negative stock. Okay, so just like cash can either be positive or none, if we have negative cash, what does that mean? It doesn't mean we have negative cash. It means we have an obligation, right? We owe somebody money, but we don't have any cash to show for it. Same here, okay? Okay, what about, we're keeping going with the same company. This company's sitting on now a pile of $40,000 of cash and a bunch of shareholders who own that cash. If they were to just close up shop right now, everyone would say, well, give me my money back. Right? Now, would they get it all back? Maybe not, but hopefully you'd get most of it back because they haven't done anything with it yet. Now the company's going to start to operate, and it needs to hire some employees and have them start working. Okay? So a week has gone by, and they need to pay their employees $1,000 in wages. What's going on? Yeah. Okay, so what does it mean to credit cash? Okay, so I'm taking cash, I'm giving it. Here, I am the company, you are my employee, here's some money. So I don't have it anymore, right? So my cash is going down. That means I have to credit it, right? So cash is an asset. When it goes down, minus 1,000, well, that means I have to credit my cash. Okay, go ahead. Okay, so what is help me understand what this really means. What is an expense? Okay, so it's part of owner's equity. What is it? What am I doing with the cash? I'm basically using it up. Why am I using it up? I mean, if you're my shareholders and I just tell you, well, you know what? I took $1,000 and I got a manicure and a pedicure and a facial and a haircut. That's $1,000. That would be a pretty pricey haircut. But okay, let's say I do that. What do you think of that? Is that a good use of resources? No. Why should I be spending money? Why should I be incurring expenses? What are the benefits that are going to come out of it? These employees are working to get the system in place so that I can then generate revenue. Now, couldn't I argue, well, as long as my hair looks nice, I'll be a better CEO, and as a CEO, I need to, maybe. Okay, that's where every now and again you'll read these articles about, sort of crazy expenditures on the part of the CEO, and you'll think, well, seems a little hokey to me. But okay, so here we have expenses. Why are we willing to incur expenses? Because we think they will benefit us and generate revenues above and beyond the expenses. If not, we have a really bad business model. So if we just keep paying our employees and they don't generate any sales, we're only going to last for 40 payments and then we're done, right? So we've got to actually turn these expenses eventually into some sort of way of producing revenue, okay? But for now, my salaries are basically consuming whatever eventually will be part of my earnings. So hopefully I'm going to make some money, and it will be offset by the component of owner's equity, which is an expense. Okay? Posting here. Now, if we want to kind of keep a running tally from the previous slide, how much cash do I have to use now at this point? 39,000, right? We didn't really use a T account to tell you this, given we've had a whole whopping 2 transactions, but you can see what this is doing for us, right? By using this technology or this kind of approach, we can make a T account which will summarize all of the activities in one kind of account, so then at the end of the period, we can just tell you in a summary way, here's what happened to cash. Here's what happened to assets, or here's what happened to property, plant, and equipment. We don't want to know what happened to every. I can't possibly tell you every time my cash goes up and down as an investor. If I did, you would have, again, like companies use cash a lot. Okay, you'd have thousands and thousands and thousands of entries. You just want to know up and down what's the net effect. Okay, so that's why we do these T accounts. Okay, next. Let's say the company buys equipment on account for $5,200. What's going on there? Yeah. Okay, so I owe somebody $5,200 because why? Because they gave me a machine. So I have the machine, it's mine, it's really mine, even though I haven't paid for it, it's mine. So what has gone up in my world? Liabilities and assets, right? I have a machine, and I have equipment, which is an asset, and it's gone up. Okay, so my assets have increased by $5,200, and that's a debit to assets. But at the same time, I also have increased my obligation. Okay, I didn't use cash on hand. Instead, I incurred a liability. In a few weeks, when the invoice comes for this equipment, I need to pay it. Okay, why am I buying an asset? Well, I'm hoping that, together with my employees all working, is going to result in future revenue. Okay, I'm hoping I have enough money to pay this obligation when it comes due. But for now, I just record an increase in an asset and at the same time an increase in the liability my accounting equation holds. Okay. So this is sort of what you'll typically see as the accounting cycle. It's not, in my opinion, 100% correct. Because, so here's what happens. First, you take all of this lengthy information, we engage in transactions, and we write it in a nice simplified journal entry. okay? You just have basically a couple of columns in your spreadsheet. The first is, what's happening. The second might be some reference numbers and then the amounts. Then you take that and you put them into specific key accounts, okay? Then you just double check that you haven't screwed up anywhere. Because even though accounting systems are highly automated and you would think that you couldn't screw up, lots and lots of companies have to restate their financial statements every year just for errors that have absolutely nothing to do with fraud or judgment or incorrect interpretation of GAAP, but just frankly mistakes, like I recorded something incorrectly. So if you record something incorrectly, you want to catch it early enough before you're really too late and you actually show your auditor the mistake. Then we have the process which is called adjusting. Does anyone remember what happens in the adjusting process? That's what happens in the closing process. So what about what happens in adjusting? Not errors, yeah. Okay, well, if I paid for it, that would have created a transaction. So you got some of it right, yep. Okay, depreciation is an example of an adjusting entry. Why is it an example of an adjusting entry? What is depreciation doing? It is decreasing the amount that is recorded, but why? Why are you doing that? Yep. That's true, but I'm not trying to actually figure out what this is worth. I'm not trying to say how much could I sell this for or how much could I buy it for today. What I'm trying to do is I'm trying to say this year I've used this asset. Okay? I have benefited from it, but in order to generate revenues, I needed this asset. But that asset comes at a cost. It doesn't come for free. When I buy the asset, it's not going to last me forever. It's only going to last me a specific number of years. So I need to make sure that I allocate the cost of buying the asset over the period of time in which it provides me benefits. Okay, so it's not that I'm trying to make sure my assets somehow mimic the market value. I don't care about the market value of the asset. What I care about is that I spend money to buy an asset. 5 years from now, that asset's going to be worthless. When did I get, why did I spend money on that asset? Well, because I was using it throughout the past 5 years and it was providing me benefits. It's just like salaries, okay? But the difference is I paid for the asset all up front and I used it over 5 years, whereas with salaries, I just pay my employees as they go, okay? So adjusting entries are events that have not been journalized, okay, but that should affect the current period. So let's come up with some more examples of adjusting entries. So I buy supplies up front, okay, and then I use a lot of them. Every time I use a supply, I'm probably not making a journal entry. So at the end of the year, I count up how much supplies have I used, and I record the missing supplies as supplies expense, and I get rid of the supplies inventory. Okay, what are some other things that are adjustments? Prepaid. So I pay in advance for my rent. What happens? Well, by the end of the year, do I have all this rent coming to me? No, because I've used up my rent. Okay, so an adjusting entry is anything where you pay in cash in advance and then you're using it up. So an asset is like the biggest form of a prepaid. Okay, it's just I'm prepaying for 5 years worth of the asset rather than prepaying for just say 1 year worth of rent. So what about on the flip side? What if my employees work for me and I don't pay them yet? Not that I'm never going to pay them, but let's say the employee work week is, I pay them every 2 weeks and I pay them on Fridays, and this month happens to end on a Monday. Okay, so they have some days of work that they have contributed, and I've benefited in this year, say in 2012, but I'm not going to pay them till 2013. Shouldn't I record the expense for those salaries in 2012 in 2012, at least for the amount that they've worked. And then the rest, and so any time that I don't pay cash, but my employees have worked for me, those are accrued expenses, or things like taxes. I may not pay until April, but the tax obligation is the result of all of the benefits in 2012. Or what are some other accrued things? Interest, right? So I may have a loan that's outstanding. I don't have to pay the interest for another 6 months, but time has passed and I've benefited from having borrowed that money. So adjusting entries are transactions that don't automatically get journalized because they're not using cash. Okay, whenever I write a check or use cash, like literally cash, a transaction automatically happens, assuming I don't have the worst accounting system in the world. But when I use the cash up front or I use the cash later, then at the end of the period, I may forget. It's not that I've forgotten. I just haven't made all of the entries that I need to settle up for the year. So the adjusting process allows me to settle up so that the current period reports reflect all of the current period activities, even if cash has not been paid or cash was paid earlier and hasn't been fully consumed. Okay. Then the part that's sort of not super right about this is we need to kind of do these things a little bit together, which is closing and creating the financial statement. So ideally what we do is first we create an income statement from all the expense and revenue accounts. Then we close the expense and revenue accounts into income summary and then into retained earnings, and then we create our balance sheet and other financial statements. Okay, so we first create the income statement, then we close, then we create the balance sheet. Okay, and then what is the purpose of closing? When we close, it means we make the balances in all of our expense accounts 0 and in all of our revenue accounts 0, and we just sort of shove it into retained earnings effectively. Why are we doing that? Okay, so one person said because they're temporary, and why are they temporary? Because for an income statement account, I want to show how I performed in just this period, right? So I need to start at 0, okay? And each period just look at what were the expenses and revenues just for this period. It could be a month, it could be a quarter, it could be a year. It doesn't matter how often you close. The point is, at every point of closing, you're starting over from 0. Now, do you start all the other balances at 0? So let's say you have $100,000 in cash. Should I make that balance 0 at the beginning of the year? No, because if on December 31st I have $100,000 in my checking account, if I don't have that $100,000 sitting in my checking account on January 1st, there's a problem at the bank, right? It's not that I'm just like, taking the money and sitting, deciding to like burn it on fire, right? I still have it. Same with the assets. I'm sitting on, a piece of machinery. I own it. I still own it next year. I still own it at the same amount. Okay, it's only that income is trying to reflect only what's going on in one period, whereas assets are telling you at any given point in time, here's what your stock is. So that's what sometimes you'll hear people talking about, stocks versus flows. Flows are, the changes from year to year in the accounts that are related to income. The stock is what you have at any point in time related to the balance sheet. Okay. So here we are creating the balance sheet, income statement, and statement of cash flows, and then start all over again, okay, for the next year. And then we have to decide, so far we are pretty comfortable with, okay, we know how to mechanically make journal entries, but we have to decide, do we even bother making one in the first place? So remember last class I said, well, what happens if the CEO shows up wearing a red tie and we all decided, yeah, you probably don't need to include that information? Well, why did we say we don't need to include that information? And so the answer is, well, in order for a transaction to be journalized, so meaning put into a journal entry form, you need a couple of things to be true. First off, it needs to happen between an internal and an external party. Okay, so by that, I mean, let's say the company were to divide itself into Division A and Division B. And in Division A, they make tables. And in Division B, they sell tables. Okay? This is one company, though. So in Division A, they could tell Division B, hey, buy all of the tables we made. Then they can report lots of sales revenue. Now what happens when B buys tables? Well, they record tables and however much they pay for those tables, or potentially like a liability, okay? Overall, this company is going to look like it had sales revenue because component A sold to component B. Did they actually sell anything? No. I mean, A and B they're right here. They're right next to each other. They're the same company. So we can only record a sale when A and B are separated parties, when they're different and there's an arm's length transaction. Because otherwise, A can force B to just buy whatever it wants just to report higher sales. Okay? So there has to be an external party. Now, there are some exceptions, but this is generally the rule. Okay? So these need to be separated. Now, the second thing that it needs is it needs to be measurable. Now, this is where your judgment comes into place. So, measurable with a reasonable degree of precision. You don't have to be, it's not perfectly measurable. We may not know exactly what something is worth. But here's where the problem comes in, which is, what is reasonable? What do you think? So here you are, you're an accountant, and you try and figure out what something is worth. And you think, well, 50-50 chance it's either worth 100 or 0. Is that, so you could say it's worth 50, right? Because on average, that's what it would be worth, but it's never going to be worth 50. It's either 50 or it's either 100 or 0. Is that reasonable? No? Well, why not? Well, what's reasonable? How do you define reasonable? Okay, so you think it's a company-specific degree of reasonability. What's reasonableness? I guess that's the word. How do we, as accountants, decide what's reasonable? And this is a problem because this is not defined. The degree of it's not saying if you're 75% sure, then you've got reasonable precision. It doesn't say that. It just says reasonable precision. So your reasonable and my reasonable may be very different. So this is where you're going to run into problems. Now, I think we all can agree we have no idea what the value of the CEO showing up in a red tie is. Like that is, it's not measurable, okay? But other things like, suppose we're engaged in a lawsuit, okay? We are being sued. We have no idea whether we're going to win or lose. And then if we win or lose, if we lose, we have no idea how much the court could find. So it's possible that they'll have one of these crazy sympathetic juries, they spilled coffee on themselves and now you owe, this person $50 million. Or the jury could say, well, coffee is supposed to be hot and you don't get anything. So we have no idea. Can we measure that? As an investor, wouldn't you like to know if I'm involved in a lawsuit? But what if I can't measure it? I just said I can't record it. So that's where the conundrum is. When we run out of, we don't know how to measure stuff, but we would like to, and so we have to decide when do we have a reasonable estimate and when don't we. And then the last bit is, if we have a contract or an agreement, it doesn't have to be a written contract, but some sort of agreement, we have to have part of the transaction already completed. So in the sense that, let's suppose I am agreeing with my supplier that in 6 months I will pay you $100 and you will give me 5 units of product. Okay, we have this arrangement. And it's non-negotiable. We cannot get out of this contract. We're both committed to it. Would I do anything when I first signed the contract? And the answer is no, because it's not partially executed. However, if I give them the money up front and they owe me 5 units of product 6 months from now, then I would record it. If they give me the product in advance and I owe them money 6 months from now, I would record it. But just a hypothetical contract, even if it's firm and fixed, I wouldn't record it until one of the parties has executed. Okay, so those are the 3 requirements in order to actually include something as a transaction. So if you have an outstanding accounts payable and you pay it off, is that something you would journalize? Yeah, absolutely. Cash is going down, accounts payable is going down. Okay, no problem. What about if you hire a new CEO? What would you do? Would you say, oh, well, the value of the CEO to our firm is $150,000? No, you don't know. Does the market know? They may not know. Does the market care when you hire a new CEO? Yeah. What happens to stock price? If they're happy with your decision, it might go up. So they're implicitly telling you, we think this is a good decision, but as a company, from a journal entry perspective, we don't get to write that down. We don't get to write value of our new CEO, $100,000. We can't measure it, and it's there are other reasons we can't do it either. But okay, if we sell products from one division to another in wholly owned divisions, no, right? Because it's not executed with an external party. If we buy new equipment from some outside vendor, can we do it? Yes. Okay. Now, I want you to sort of close your eyes a little, not close your eyes, but like, blur your eyes, and you'll see how this is basically a spreadsheet, okay? So what does a journal look like? Well, it's got a column for the date. I don't care if ever write the date down. I'm not that nitpicky, just whatever. The date is the date. But then you've got the transaction, the debit and the credit, okay? And you've got the amounts, debits and credits. Here is your T, okay? But this is for all of the accounts, okay, together. So what does it mean to take this journal entry and post it? Well, this is basically now your cash account, okay? Cash, here's your T account. So here, cash went up, so you put a debit. Here, common stock went up, you put a credit, okay? Don't worry about this last stuff. What are the reference numbers? Well, it's just a way of getting, so I put this in, this is the T account number 101. It's easier to do numerically, to find equality numerically than it is to find text equality, but it doesn't really matter. So whenever you post something to 101, it's going to show up either as a debit or a credit in the T account. So I want you to sort of agree, or at least convince yourself that T accounts are effectively computerized spreadsheets. Nobody's going to use actual, paper journal entries in T accounts anymore. But it's the same. Everyone's using the same system that we used for the last, 6,000 years. Okay. So, 600 years. Okay. So we're gonna now, for the next 20 minutes, I'm gonna give you about 5 minutes to just try and attack these journal entries. Then we'll discuss them. We probably won't get through all of them. We'll pick up where we left off next class, and then take it from there. So spend about 5 minutes. Write the journal entries that you can, if necessary and when necessary, and then we'll. And then you guys, I'm not going to do any of those.